Like, what do you think's happening right now? Where do you see things going in the next 6 to 12 months? What are your thoughts in terms of the impact globally of everything that's happening? What kind of impact do you think that's having here?
Definitely towards the end of that last year, we're hearing members saying a lot of fatigue, that they're always jumping from one fire to another.
Next,
generally tracking very well. When we ask them about what they're worried about, they're expecting insolvencies to increase. Only, I think, literally 2 respondents expected insolvencies to decrease.
They were very hopeful people.
That's right, and hopefully they're right.
Yes,
We've all been wrong before.
Hello everyone, and welcome to the second episode of the second season of Catherine Partners The Cut. Today we're very lucky to have a stalwart of the credit industry joining us today, Mr. Nick Pilavidis. He is the CEO of the Australian Institute of Credit Management. Nick, welcome. Thank you for coming.
Thanks for having me.
It's obviously interesting time in terms of credit at the moment. I know the industry is looking down the barrel of a little bit of, let's just say, disruption in the next probably 6 to 12 months. I know you've been CEO of the Institute for a number of years now. So I guess rather than getting into that detail, which we'll talk about in a minute, maybe we'll just hear a bit about you and your journey and how you came to be where you are today.
Yeah, so I've been the CEO for 9 years now, and there's always interesting times. I think that every year's been very interesting. My journey to the AICM came through being a credit manager myself, or credit professional. Started as in the debt collection field, working for some debt collection organisations for about 4 or 5 years, which was a great experience. I sort of didn't go into expecting to work into credit or debt collection especially, but I really wanted to work somewhere where I could learn a lot about business and be very central to an organisation and really support it. So the credit industry really spoke to me through those roles in debt collection, where at a very young age, I'd done a bit of study, but not a lot, and got the opportunity to work directly with business owners, individuals, directors, insolvency professionals, and all those sorts of things at quite a young age. So that sort of spurred an interest in that field, and what a great contribution you can make to an organisation and get some good achievements. It's always great to be able to resolve an outstanding account and see that achievement every day, lots of times like that, and dealing with complex situations a lot of the time. So really enjoyed that. Did my year travelling overseas and worked in a property management firm there, collecting rents from some A-listers and things over there, which was really interesting. And
very good.
Came back to Australia and landed a role with Ricoh Finance, the photocopier company, and worked my way up there over about 14 years, I think I was there in total, which is a great organisation and really supported my career, and through that journey got involved with the AICM. So I remember my first experience was getting shanghaied into doing the Young Credit Professional of the Year award back when I was.
As you do in those sorts of roles. Obviously, when you're volunteering all the time, you put your hand up, it generally keeps getting raised by other people, so I can appreciate that. Yeah,
that's right. No, I got encouraged to do that by one of my managers at the time, Angela Marchant, who's still in the industry and well recognised, and got involved in the Young Credit Professional Award program, which really opened my eyes. I think as I entered into that in my mid-20s, I was thinking maybe one day I could be a credit manager of a small organisation, not something like Ricoh, a big multinational organisation. But by the end of it, I was exposed to the credit managers of Qantas and all these big companies and saw what there's a potential in the career. And that really fueled my interest and got me involved in AICM volunteering.
Yeah, amazing. It's always interesting when you come out of school and you're kind of trying to decide what you want to do. I mean, myself, I didn't obviously envisage being a liquidator, but
not many people aspiring to that in kindergarten.
No, definitely not. It wasn't something that the career people suggested that I could do when I grew up. But it's great to go out and try something, and then if you can find a passion for it, which I know you obviously have now, it obviously puts you in a great place in terms of progressing in your career and getting to a point where you feel like you're contributing. And I know obviously through my interactions with the AICM and the credit forum as well, that you're a member of too, that level doesn't go unnoticed, and it's definitely adding to your, I guess, legacy in terms of the credit industry. So yeah, it's very interesting just to hear about people's journeys in that regard, and when you get to a point where you're leading something like the AICM and giving back, as I said, it's just something that you'll look back on when the time comes to hang up the shingle, and you'll be obviously very fondly remembered and appreciated, your journey yourself. So,
thank you. And it's a great honour to have this role. That through the AICM I was able to advance my career a lot, and rose through the ranks at Ricoh from a junior to the national credit manager, and looking to do lots of different things. So now to step out of that and to work as the CEO of the organisation and help give back, as you say, to help others through our Young Credit Professional Awards or the education that we run, or representing credit managers in government submissions and things it's a great opportunity that I don't take lightly, because I know it's a great career, can really help people. So
amazing. And speaking of government and parliamentary inquiries, I know yourself, as obviously the representative of the AICM, have recently been in front of the parliamentary committee in relation to corporate insolvency in Australia, and I know you've done some stuff in terms of the personal insolvency roundtable as well. So I guess looking at the submission process that you've been through, give us some insight into that process. And I know I sat in one of the hearings behind yourself and Anna Taylor at results there in terms of the submission that you were putting forward for the AICM and Anna on behalf of the Credit Forum. And it was just interesting for me to experience that. But obviously the preparation that goes into it and the canvassing of members and all those types of things, just give us, I guess, some insight into that process.
Yeah, I guess where do you start with that process? Probably 9 years ago when I started the AICM, we'd always done a lot in the AICM around insolvency, but coming from being a credit professional to now, what do credit professionals need to do their jobs better? And for me, it was clearly around insolvency. That it was, as a credit professional of a multinational organisation, and we had several insolvencies a month, I still found it really complicated and hard to navigate that insolvency world. So that's something I've dedicated quite a bit of time to in this role, and working closely with ARITA and other bodies to understand that. And I think and people like yourself to build up that connection between credit professionals and insolvency professionals. I think going back 10 or 15 years was quite a combative relationship. I think we've come a lot closer to being friends now, which is great, because we're obviously a major stakeholder in the insolvency process, and that's really good. But I've been constantly submitting to all the little tweaks that they've done through insolvency over those 8-9 years, and really seeing it's too complicated and too hard for credit professionals who are paid to understand that. And I always look at it from a small business lens as well. They're caught up with it just as much as credit providers, and how's a mum and dad operation supposed to navigate the insolvency process if a credit professional finds it hard. So,
absolutely. And I don't think you'd be the only person in that camp. I know obviously the feedback that I've got from the Credit Forum and the, I guess, peripheral view that I've had of the AICM submissions, there's a lot of things in there that I don't think either of us would want or continue to want to have in those particular pieces of legislation, because you're right, there is a lot of complexity around it. And even from my side of things, the PPSR, obviously it's been in for 10 or 12 years now, but the complexity that comes out of that in terms of attachment to debtors and the PIMSy side of stock and the process and the time that it takes to account for all of those things, it burdens the creditors overall, but it also, whilst good credit managers are putting together their terms and making sure that those things are included in it so they can protect their positions. It's even a lot of insolvency practitioners have trouble working through that process, and it's definitely something that I know you've put some submissions in and in relation to, and hopefully there's some traction that's come out of the most recent round. It from sitting in the background, it appeared that the people that were on the committee were actually taking quite a detailed interest in particularly your submission, and I know the credit forum's one as well. You were asked to take questions on notice, which I know you've now put together and resubmitted. So tell me your thoughts in terms of the most recent one. Do you think there's more traction? Is there more appetite for change at the moment? Where do you think we see it?
Yeah, definitely. I think that's definitely how we've left that inquiry process, and we're waiting the final report, but definitely feel like there's that general agreement for change. Hopefully that is sustained. There's some quick wins that I think can be achieved with further tweaks to legislation, but to get the holistic change and simplification that I think we need to really give credit providers confidence in providing credit, to freely provide that without the hurdles that they need to go through to protect themselves from things like preference claims and the complexities.
I was wondering when they were going to come up. I was just waiting, biding my time.
I can never not talk about preference claims, and that's the area that I think a lot of people relate to, because small business owners are impacted by them just as much. If I talk to a small business owner about what I do, they sometimes struggle to understand it.
Yeah.
And if I mention preference claims, they either still struggle to understand it.
Yeah.
But if they've experienced one, then they really know what it's all about, and they can really vent their frustrations.
Oh, it's absolutely it's something that appears to, I guess, prosecute people that have great collection practices, and it definitely needs some tweaking. And I know that's a very big part of the submissions that you guys have put into the inquiry. So it'd be interesting to see what comes of that. And I'm sure that, like you said, there'll be some quick wins that come out of it, and hopefully there's a bit more of appetite to look at it from a holistic perspective, because there's other things that have come out of that too. And even recently, I know one of my contacts who's in the credit industry had an issue around trusts and the operation of the insolvency regime, particularly on the corporate side of things, and companies acting as trustees for trusts and registrations, and is it registered over the right one, or who's actually the party here that we're going to be able to hold to account. So yeah, and again, from my perspective, that's something that I'd like to see change as part of these reforms too, so hopefully that comes through.
Yeah, no, trust is definitely my next biggest hobby horse as well. If we look at things that frustrate credit professionals and business in general, it's trusts. Just from how do you contract with a trust? There's so much ambiguity around that, and that can change any minute now. So, we're big on changes that will simplify the operation in insolvency, which should be a short-term win, but also there needs to be more structure and clarity around trusts and simplification. So we're a big advocate for trying to establish something like a trust register where it can be clear who the trustee is. The trust deed is registered somewhere publicly accessible, and that gives legal effect to it rather than being hidden and not known about.
Sure.
And understanding the beneficiaries. So that could be something that conceptually is quite simple.
Yep.
Doesn't need to change the operation of trusts and doesn't need to change all the other uses for it. But when it's a trading trust that's incurring liabilities and trading with the public, then we think there should be more clarity around that could be simply provided through a register.
Yeah, look, that's hopefully an option that's being looked at. It's there's obviously arguments on both sides in terms of the reason why trusts were established in the first place, but yeah, I agree. Even in my circumstance, where there's a trustee company, generally the trustee has some sort of automatic termination clause, and then you get into bare trust territory, and then I've got to make applications to the court to get access to those assets. And that obviously, again, adds another layer of complexity and costs in terms of the process. And ultimately, at the end of the day, unfortunately, creditors are the people that bear that cost. So, yeah, it's definitely something that is on my radar in terms of that operation as well.
We embarked on creating a short course for credit professionals to understand how to trade with trusts, took us 12 months, and it's a half-day facilitator-led course to be able to get people to understand just how trusts operate and how you should train with them.
I reckon you could probably have done a 2-day course and you still wouldn't get across the whole lot.
Just touching the surface, yeah.
But no, that's obviously good in terms of adding benefit to your members. So, I suspect that a lot of people would have got some good insights just out of that half-day course. It's just one of those areas that we have to continue to look at and think about in terms of trying to get to a result that's fair for all, and obviously something that we'll keep looking at.
Definitely.
In terms of the bankruptcy roundtable that you were at recently, give us some insights into what's happening in that space. Like it seems to be that they're trying to do it all at once, which is interesting given the fact that the corporate side of things is quite complex and the personal side's just as complex. So. Yeah.
Well, that was a big part of our submission, is to unify corporate and personal insolvency. When people talk about businesses collapsing, they talk about bankruptcy, they don't talk about insolvency.
Yeah.
So the general perception is it's one and the same. And there's just lots of complexity about having two regimes, and we love to see that simplified. So it's great that they kicked off that round table at the same time. And it was very interesting going from the PJC corporate insolvency inquiry. I think it was on a Tuesday, and then the Thursday was the Attorney General's round table into personal insolvency, and actually had to think for a while, what are the things we need to change with personal insolvency, because comparatively it is very simple. There's basically 4 processes compared to corporate, where there's a lot more than 4 processes, and the regulator operates quite effectively as well, and it seems to operate comparatively very well. But it was a great round table. It was actually a square table, and it was done alphabetically. So you had the associations that all start with A on one side, and a lot of the consumer advocates on the other side. But it wasn't a big division and a standoff across there. There was a lot of commonality and understanding of what we want to achieve, which is really make the system work for all participants, and especially when individuals are experiencing hardship and vulnerability and mental health issues and all those extra situations that can accommodate for that. So there was some good understanding around a few things. Thankfully, the 12-month bankruptcy didn't really rise its head again, although there was general agreement that there should be some simplified process, kind of like the small business restructuring, but something for low value, no asset sort of bankrupts where they can go through bankruptcy quite quickly. I know in New Zealand they have a similar process where I think it's based on age as well. If you've got low value, no assets, you can go through that quite quickly, but it's a once-only sort of situation. Hopefully you learn by that and don't be seen again. And that could also be wrapped around with some education for those individuals around how to manage their debts and things like that.
Yeah, sure. It's there's definitely scope for that in my view as well. It's just trying to find what that level is. Is it a quantum in terms of debt? Is it a number in terms of debt? Is it an age thing? It's something that I'm glad people are talking about, because there's definitely merit in trying to implement something that's a bit more simplified from that side of things, depending on obviously the position of the debtor.
Yeah, especially when the majority of bankruptcies are individuals and they're not involved in businesses and they're not complex. So hopefully we can right-size the process for those individuals.
Yeah, it's a societal thing too, because obviously you've got marriage breakdowns and unfortunately gambling problems or substance abuse, those types of things that lead to a lot of that consumer bankruptcy, and trying to find an appropriate way to deal with that from a commercial perspective as well as a health and well-being perspective is something that probably needs to be grappled with a bit more.
One of the, I guess, where we sort of saw a bit of difference was the call for the bankruptcy threshold to be lifted to $40,000, $50,000, and the time to respond to a bankruptcy notice to increase from 21 days out to 60 days. So sort of understanding where they're coming from, that relatively low debts shouldn't result in bankruptcy, and people should have time to respond and prepare a response, especially if there's hardship and extenuating circumstances there. The problem is that no one wants to enforce bankruptcy.
Yeah.
As a credit provider, we need to know there's some line in the sand where there's got to be some engagement with the credit provider to be able to resolve the debt. So even with a small amount, that fear of bankruptcy keeps people engaged with their credit provider.
Sure.
And that's our driving mantra, is we want bankruptcy to be a last resort and encourage individuals to engage with their credit providers to resolve their exposures. And therefore, we need also credit providers to be best practice.
Yeah.
A lot of the issues that the consumer advocates see are from poor practice.
Sure.
So very big that if that's the case, that we need to enforce those and make sure that best practice is undertaken. So, yeah, we're very keen for the threshold to be kept at a reasonable level, but find avenues for the individuals to get the right support. So that might be through making sure that there is information about financial counsellors provided from the first serious demand letter that a creditor provides, not just on a bankruptcy notice, and all the way through, so they can engage. And maybe if the 21 days does come up and then the individual contacts a financial counsellor on day 20 or day 21, then the counsellor could have avenues to extend that period to be able to work with the individual, because we all know that individuals sometimes leave it to the last minute to get some action. So if there's those extenuating circumstances can be verified by a financial counsellor, then that could leave an avenue to
extend it and obviously for you guys or your credit managers to work with that individual.
Get the right outcome, whether it's the credit provider might understand the circumstances better and provide some assistance, or even not enforce the obligation, or for the counsellor to help them reorganise and be able to meet their obligations and hopefully avoid bankruptcy altogether.
Yeah, look, there's so many ways that we can be proactive as professionals, not just from the credit side, but even from my side around that communication piece. And it's something that I even just in terms of the people that work in our team, I'm always saying pick up the phone, communicate with these people. That process is going to, A, hopefully short circuit any kind of misunderstandings, and B, hopefully get to a better commercial resolution than if we're both just trading emails at 10 paces. So it's something that I'm obviously aware of in terms of our business as well. So there's some good thoughts there. So hopefully they get taken on board. Yeah,
and I hope that's something that we see continue on past COVID as well, that we've seen a lot more engagement during that period, that businesses and individuals have called up for support and credit providers been able to provide that, and we've seen less enforcement during that period, and that's continued on. So if we can increase that engagement, open conversations to work through things, then that's going to be a win-win for everyone, that we can get payment. Maybe it's going to take longer, but that business or that individual is going to continue in a positive way. Yeah,
absolutely. In terms of what your members are seeing at the moment, like what do you think's happening right now? Where do you see things going in the next 6 or 12 months? What are your thoughts in terms of the impact globally of everything that's happening, failed banks, runs on those types of things in Europe and America? What kind of impact do you think that's having here?
Yeah, I think first of all for our members it's having quite a big impact, because we've been going from, even if you look back to 2019, things were very uncertain then. A survey of our members showed that was their biggest concern, economic uncertainty in the end of 2019, and then it's not got any more certain since then. And then we've gone from one fire, literally, in terms of natural disasters, floods, those sorts of things, to the pandemic and insolvencies. We're going to have a tsunami of insolvencies, always worried about that in the next 6 months. And we've gone through the pandemic, and now it's the banking crisis, inflation rates, interest rates, global uncertainty with Ukraine and different things happening around the globe. There's always something for credit professionals to be worried about, and how that's going to impact their customer base. And that definitely towards the end of that last year, we're hearing members saying that a lot of fatigue, that they're always jumping from one fire to another,
next, yeah.
but it's not really materialising that the actual risk hasn't seen on their ledgers. So our survey of members earlier this year, just in February, showed that they've generally held their performance, their targets of their ledgers have held. A few have deteriorated, but that's been largely where they've had staff issues or specific issues for their business. I think around 35% of them had improved results in 2022 versus 2021, which is great, but that was down from 65% the prior year. So obviously a lot of improvement in 2020 and 2021, and then probably the only way is up from there.
Yeah.
So definitely seeing less improvement, but yeah, generally tracking very well. But when we ask them about what they're worried about, they're expecting insolvencies to increase.
Yep.
Only, I think, literally 2 respondents expected insolvencies to decrease.
They were very hopeful people.
That's right, and hopefully they're right.
Yes,
we've all been wrong before. But the majority thought that it would hold about the same level, and about 30%, I think, expected increases in insolvency.
Yeah.
But then when we look at their expectations for their ledgers, they're still quite optimistic on being able to maintain their current performance levels or even continue to improve it. So I think that's very positive that credit professionals feel they've got enough tools in their toolkit or enough there's enough resilience in the economy to weather the risks that they're really worried about coming forward.
Yeah, great. Obviously, you've said now that you've done this recent survey and the sentiment hasn't really changed. It's obviously people are starting to think more broadly in terms of issues with insolvency and those things that we've seen kind of starting to work their way through in the last 6 months. If you could draw a line in the sand today, what do you think is going to happen next month, like the next 3 months, say, from a confidence perspective? I know interest rate position now seems to be getting to a point where a lot of people personally are starting to feel the pain. I know my fixed rate myself comes off at the end of May and my mortgage payment's going to go up $2,500 a month. So I'm fortunate enough to be in a position where I can handle that. There's got to be people out there at the moment that can't. So what's your views there?
Yeah, we did a bit of analysis of that in our risk report that's out at the moment, just released in the last week or so, where we compared both corporate and personal insolvencies to the interest rates, the RBA cash rate. And historically, that's tracked very much in line that as interest rates go down, insolvencies go down. As interest rates go up, insolvencies go up. In corporate insolvency, we have seen that increase over the last 6 months. There's been an increase back to the 2019 levels, but when you track it historically, for the first time, the interest rate level's sort of gone above the corporate insolvencies. So it looks like the trajectory of corporate insolvencies is a lot lower compared to what you'd expect based on that increase in insolvency rates. Or interest rates, sorry. So there seems to be a clear lag there that the interest rates are yet to really hit on businesses, and maybe that's because there is just a natural lag, or maybe that's because the businesses are still cashed up and balance sheets are looking strong. But from that assumption, it's the only way we can assess things is looking on the backwards. You'd expect a significant increase. But when we look at personal insolvency, there's been no increase in the levels of individuals going into bankruptcy, and there's been a significant decrease in the bankruptcies triggered by credit providers. So there's a lot less enforcement leading to bankruptcy, which may or may not be a good thing. Obviously, it shows that we're working with the individuals, but there might be more individuals out there under that stress that may come through as well. So I know Tim Beresford, the CEO of AFSA, who manages bankruptcy, has predicted significant growth in personal insolvencies over the next 6 to 12 months as well. So we do expect those increases in insolvencies, and members are starting to report that their ledgers are generally looking good, but within their ledger, there's those problem customers that are now starting to raise more disputes, those sort of disputes that come before they stop paying.
Yes.
And in the consumer sector, more instances of hardship coming up as well. And I know that was reflected by the banks earlier in the week as well, where they're saying generally their portfolios are looking good, but when you look at a more granular level, seeing lots of individuals starting to display signs of hardship and stress.
It's interesting. I mean, obviously I've seen the corporate side of things in terms of the increase of work myself, but I just don't know when that tipping point is, because it feels like it's been a tipping point for the last 2 or 3 rate rises, and people seem to be still hanging on and being in a position where they're under some duress, but are still being able to make their payments. So I just thought that there might have been some sort of indicators from your membership where that's starting to change, and it seems like when you're starting to get into dispute territory, or we're seeing just broadly more fraud that seems to be coming to light in different circumstances. Those things to me are kind of the canary in the coal mine bits around something giving properly in the next little period. So you'd be interested to see what happens there.
There are a lot of reasons to be positive, of course.
Absolutely.
There's very low unemployment, so people still have the income coming in, so they're not feeling that real pressure as yet.
Yeah.
I think, we need for there to be that significant uplift, something else has got to change, like those unemployment numbers. And talking to some small business groups recently through the Chamber of Commerce, they are seeing that demand side of the equation, where the last 2 years has been supply side costs and those sorts of things increasing. They're starting to see demand start to come off as well. So that's that pinch point where you've got high input costs, then they're still going up, and demand coming down. And we definitely know a lot of small businesses are carrying a lot of ATO tax debt, which is the maybe not the canary, but the big vulture in the room that's hanging over us. Yeah.
Well, even just anecdotally, you can see in the last probably 2 or 3 months, the activity from the ATO side of things has definitely increased. There's definitely a lot of wind-up applications that have been filed. I won't say it's back to pre-COVID levels yet, but it's definitely increasing and substantially increasing. But the other thing I guess that leads me to is the reportable default position that I know you've done a lot of work with in terms of submissions and trying to get to a point where there's a number on the table that the ATO is now reporting or notifying credit agencies of corporates that are having tax debts over, it's $100,000, isn't it?
That's right, yep.
What have we seen much of that in terms of what's being reported at the moment, or where do you see that going?
We have been heavily engaged in that. I think that was one of my first goals, to see a ATO default on a credit report.
Yep.
Because a lot of people are surprised that it doesn't get reported. Credit providers don't know if businesses are paying their tax debt or not.
Yep.
And our members are continually frustrated when an eventual insolvency happens and they see literally years of accumulated tax debt that's caused that. So we've advocated strongly for that. Did come through in I think it was 2019, 2020, but obviously wasn't implemented during COVID. And we saw last year the ATO start to use that measure, which is obviously a clear way to get payment, pay your tax, or there might be a default lodged against you, which will affect your credit rating.
Sure.
So they started that off last year with quite a few thousand of letters sent. But I think we've only seen around a few hundred, if that, in disclosures made to credit reporting bodies. I asked a group of 30 credit managers if they'd seen a default on a credit report, and only had 2 hands go up in that room. So that's a bit frustrating that they're not using it to the extent that they should be, considering the growing pile of ATO tax debt that goes up by double digits every year, while other ledgers are going down. Theirs are still increasing. Yep. So that burden that's out there, that's a hidden risk to credit providers, isn't being used. But that's sensible to take it slow. We want that measure to be used and to stay a permanent feature. So we wouldn't want some unintended consequences happening. So it's a slow rollout by the ATO to focus on those most recalcitrant entities.
Yes.
And they're starting to increase that with more letters going out, more warning letters and things like that.
Yeah, okay. Well, I mean, obviously positive in terms of it's in place now. Now it's just, I guess, tweaking it to make sure that you get the balance right in terms of what's being disclosed and how that process works from a timing point of view, and giving the taxpayer 1,000 opportunities to do what they need to do in terms of getting their lodgements up to date and payments made. So, yeah, look, I'll be interested to see how much more disclosure happens, in the next 12, 18 months, 2 years, and hopefully they can kind of land on a good approach to it, so that there's enough information being provided to credit managers and to people at large that are looking to trade with businesses, and that kind of is tempered by I'm assuming, privacy requirements and the things that go along with that from a government perspective. So.
Yeah, I'm not all that confident we'll see a significant ramp up in that.
Yeah.
In that the requirements of the legislation are that once a disclosure is made, if the business engages to make a repayment, then the disclosure gets removed from the credit file, like it was never there. So something that our members aren't all that happy with, and seems a bit counterproductive, that that business that was risky enough to be disclosed one day makes a repayment arrangement the next day and is seen as good credit risk on a credit file because of that engagement.
Yeah.
But I'll go back to my earlier comment. That's what we want businesses to do, to engage with their credit providers, whether it's a commercial entity or the ATO, engage with them and work through their obligations. If a business is engaging with the ATO and meeting their obligations, then hopefully that business will continue and not be a risk. And that's really what we want at the end of the day. So
yeah, absolutely.
To see that measure being used.
Oh, look, it comes back, like you said, to that engagement piece, and if you can get people on the same page in terms of communicating and trying to come to some sort of resolution, like you said earlier, that's a way better outcome for everyone collectively than having to go down the enforcement path. But having that stick available is obviously there, and it's another reason for people to engage. So
exactly,
it's a bit of one in one hand and one in the other, and trying to work with both. So
I think that's probably a factor that is driving those increased insolvencies, because they seem to be director-led insolvencies rather than creditor enforcements. So it's probably that pressure that then it either gets them to engage and pay, or to take the action that they probably know they've had to have done for a while, but that seriousness of it sends them to that path.
To that level. It's it's all interesting. It all comes back to human psyche and what people are thinking and all of those types of things, which I find fascinating. But,
definitely.
Look, I mean, obviously we've been talking quite heavy in terms of issues in insolvency and credit management issues, but I'm going to change tack a little bit here. I know you're a rugby fan. I am myself too. So how do you think the Waratahs are going this year? What's your thoughts on the World Cup? Where's all of that at?
Yeah, I guess if we've got some problems in corporate insolvency, we've got a few problems in rugby as well. Definitely not an expert in that, but do enjoy getting involved. But it's a bit of a hard yakka supporting both teams at the moment. We've got Eddie coming in to fix all that for the Wallabies, so it'd be very interesting to see what happens there. The
saviour's come back. No, it's interesting. I went to the game last weekend actually, and the Waratahs played all right, but they're still a step off the mark in terms of competing with the Kiwi teams, unfortunately. But obviously France coming up, so I'll be interested to see how Eddie works his magic, given he was the orchestrator of the great Japanese win over the Springboks a few World Cups ago, and then obviously England beating the All Blacks in the semis of the last one. So it's certainly interesting times in Australian rugby, that's for sure.
There's some good depth in the players, though. They've got some good potential to bring through, and if Eddie can get them working to their best, then I think we've got just as much chance as anyone. So it could be a good World Cup. I
think you do. I think the Irish will be there at the front of the queue, along with the French probably. But
exactly.
I think the Aussies might be a bit of a wild card, so watch your space. There you go. And what about other things you like to do outside of work, Nick? What else happens on a Saturday afternoon when you're at home and you don't have to focus on what's happening at the AICM?
Yeah, well, at the moment I'm dealing with some post-rugby issues with a bad back and shoulders and things. I like to say it's rugby, but it's probably bad posture at work or something. But
bit of both, I'd say.
So we've set an ambitious challenge to do the Kokoda track in July.
Oh, amazing.
So, yeah, that's my next focus personally to do that. So it's a lot of trekking around the bush around the Manly Dam and things like that where I live. So trying to get fit for that.
Very good. Yeah, it's I'm actually doing the half marathon with my wife too, so I don't think I'll be seeing you over at the Manly track, but yeah, it's always good to have something outside of work to focus on, and
definitely,
and obviously that hopefully puts you in a good place to be performing for the AICM, and I know you are, and obviously my interactions with you have been in and around that, as well as what's happening at the Australian Credit Forum too. So, look, I appreciate your time today, and
thank you.
Thank you very much for making the effort. Hopefully everyone online's enjoyed it, and I'm looking forward to seeing how we go with the parliamentary inquiry and what comes from that.
Lots more submissions to come.
No doubt.
Excellent. Thanks, Andrew. Thanks for having me.
Thanks, Nick. Thank you for tuning into Cathro & Partners The Cut podcast. Please don't forget to like, share and subscribe to our YouTube, Spotify, Apple Podcast channels for future content from Cathro & Partners. If you'd like to hear more about us, please visit our website www.cathropartners.com.au, and thanks again for listening.